If you go back and when gold was legalized by the state in January 75, gold was then at 200. It had already gone in the cash markets from like $30 to 200. But anyway, then there was a bear market that took you down back to 100, cut in half. Okay, that was in 1976 summer. Between that low in the summer of 76 and 1980, 3.5 years, gold went up 8-fold from price low to bull high. Okay, these are monthly closes, by the way. Now, then it went sideways at a high level, relative to prior history for 2 decades almost. Okay, and then in 2001, with a low at around $260, it surged the second time. And when it peaked in 2011, a longer bull market, but the same dimension, 8-fold gain in price, bear low to bull high. Okay. And then it topped and you had to drop back to $1,050 in 2015. And if you measure that as the bear low that, followed that high, we're only a 4-fold move. Again, that low was $1,050. We're $4,000. Okay. You go to 8,000 plus, and then you could at least say, oh, gold matched its prior old bull markets in terms of ratio scale. That's not a target on our part. That's just pointing out a feature that people just are not aware of. I think we'll go well beyond 8,000. But anyway, the point being here, quit talking about gold being overdone. Okay. And then there's a more important chart, the one we're really, MSA looks at momentum and structure, but in this case, what we're looking at is simply price versus price, a spread chart. And back in 2013 in particular, gold was collapsing. Peaked in 2011, went sideways 2012, and really started to come apart in 13.
And this is gold divided by the S&P.
Yeah, this is take a front month gold future, divide its price into the S&P, express it as a percent.
Right. Okay. So anytime the chart goes down, it's the S&P outperforming gold.
And gold underperforming the S&P in this case. We could have flipped it the other way as well, but in which case you'd have a topping pattern as opposed to a bottoming pattern by gold. But anyway, you can see that since 2015, when gold made its bear low in price, that was when it was just above 50% there. It was right where gold price actually ended the downside. If you go sideways from there for 10 years, you've been either side of that level equally, meaning it depends on when you look at it, but gold's been par to the S&P. It's done just as well as the S&P with ebbs and flows, better times, worse times, but sideways. Now, but in that period of 10, 11 years, I count 1, 2, 3, 4 highs that define a gradually declining resistance line. We hit it back in April. That's when gold was surging in net price. That's when we hit it the last time there. That's April of this year. No, the other time. There they go. That's when gold was surging in price when the S&P was dropping 20%. That's not supposed to happen according to common wisdom. When the S&P gets kicked bad, gold should go down too, right? It's falsehood. Anyway, you did back off from there, and gold went sideways in price for 5 months. It hit 3,500 and just went dead. Constant selling, but no real sustainable downside gains for the bears. Now you're intra-month with a week to go in the month. You're at 61%. You close a month at 60% or higher, dividing December gold future into S&P. And that's a breakout. So what this chart is telling you is if this were a price chart and the average guy looked at it and say, oh boy, this is a major breakout, I got to buy this thing. Well, that's right. It's telling you that gold is, while it's been doing okay versus the S&P for a decade in real terms, up and down, but sideways, it's breaking out. This is just starting. This isn't some old game. It's just starting. That's a fresh breakout. Again, if this were a price chart and you saw that happening, you wouldn't say something's about the end. You'd say something's beginning. Okay. So what this is telling us is there's a major asset class shift out of especially the U.S. stock market bubble, which is probably the biggest one in the world. Many other markets don't have bubbles like we do. They're up like us, but not bubbles. And into monetary metals. We've already seen evidence of that. The last couple of years, gold's been doing well versus S&P, but it's only begun. We've just broken out of the massive base. So when this breaks out, it's likely to happen this month. All you do is hang around on the spread and it breaks out. This thing's going up for years. You don't have a base like this that go up for 2 months and then fail. This is the start of something. So it's an investment grade smack in the face. Reality's changing, guys. Something's going on. And it's also when you hit those levels before and you go about 6 months to the right, you're not fooling around. You're headed down. Okay. That resistance you didn't come back a second time and get back above the first peak. Each time you hit it, you didn't get back above the peak that hit it. You started down. And either that meant gold was going down in price or gold was going sideways like from that 2020 high, collapse in the spread was big. Gold also went down, went down 20% in price from over 2,000 to just above 1,600. But it also dropped a lot versus the S&P was firming then. Okay. In fact, S&P was making a high and NASDAQ 100 was making a price high in late 2021 when that spread was below 40%. That lowest reading you see there. That was a coincidence, but gold go down and stock market making a price peak. Anyway, since then, you pulled up, built a base, a little mini base there, and you broke out of that back in March of this year, earlier this year, and then surged up to the April high. But this time, instead of falling down away from it and continuing down, you're back above it. It's a statement of intent. Okay. Anyway, this is a table pounder, and this is the kind of thing that if you're thinking of investing long term, it's saying you need to reorient your thought process. Something's going on here.
When you really zoom out and strip away the noise, the memes, the Fed press conferences, and the polite finance world fiction that everything is under control, you start to notice that markets have a rhythm. They have these seismic structural inflection points that most investors miss because they're too busy staring at a price on their phone instead of the actual internal structure that drives it. And right now, we are at one of those moments, and I want everyone watching to pay attention because the last time we saw something even remotely comparable, gold went from $100 to $850 in 3.5 years. And people who ignored the signal spent decades regretting it. I'm not saying that to dramatize, I'm saying it because the data is screaming, and most investors are still whispering. If you go back and look at the historical behavior of gold, when it finally breaks out of a long-term momentum base, the moves are violent. I'm talking about the kind of upside acceleration where the crowd suddenly wakes up and says, wait a second, how is gold at $2,500? Didn't this thing just sit at $1,800 for 2 years? And by the time they ask the question, the move is already halfway over. That's what happened in the 1970s. That's what happened from 2001 to 2011. And now here we are again, except this time, the setup is bigger, the monetary backdrop is more distorted, and the institutional herd is more exposed than ever. You don't need a PhD to recognize the pattern. You just need to look at the relationship between gold and the S&P 500, something most analysts completely ignore because they're too focused on linear price charts instead of spreads and structural momentum, which are the real signal beneath the surface. Let me walk you through this slowly because this is one of those rare charts that can literally change someone's investment life if they understand what it means. Back when gold was legalized for Americans in 1975 and started trading freely, it had already run from $35 to roughly $200 in the cash market. That alone tells you how artificial the prior suppression was. But shortly after legalization, it corrected. It went from 200 back to 100. People panicked. Reporters said gold was finished. And then from that 1976 low, gold went up eightfold in just over 3 years. That's not a normal bull market. That's a monetary earthquake expressing itself through price. Fast forward to 2001. Gold bottoms at around $260. Nobody cares. CNBC has stopped even mentioning it except once every 3 months. And then, quietly, without anyone wanting to admit what was happening, gold enters another multi-year bull run and again delivers an eightfold increase into the 2011 peak. Same magnitude, different generation, same structural forces. And then, after the 2011 peak, it consolidates, corrects into 2015, pulls back to about $1,050, and begins building another huge base. Now here's the key. From that 2015 low to where we are today, gold has risen about fourfold. That's half the magnitude of the 2 previous bull market advances. But the most important point is not the price. It's that the structural pattern is identical in slope and character to the early years of the prior bull markets. If you map the ratio-scaled moves, gold's current run is literally following the same dimensional roadmap, just with far more monetary distortion underneath it. So if you're sitting there wondering if gold is overbought or too crowded, or if the move is too fast, you haven't studied history at all. This is not the end of the move. this is the midpoint. The acceleration phase hasn't even started. The more shocking chart, the chart that should wake up anyone still believing the S&P 500 is some kind of safe haven, is the gold versus S&P spread. If you take a front-month gold future and divide it by the S&P and express it as a percentage, you get a spread chart that tells you who is outperforming who over time. Whenever the chart goes down, the S&P is outperforming gold. Whenever it goes up, gold is outperforming the S&P. Simple. Except here's what's not simple. This spread has been quietly building a decade-long base since 2015. And it's not just any base. It's a symmetrical, well-structured, multi-touch resistance pattern with 4 separate price highs, each lower than the previous, converging into a declining ceiling.
And there's another spread we're watching also, if you want to flip a few pages beyond in that report that we were looking at. This is a very informative chart. It's effectively hit what it's saying is zero. Okay, I'm not going any lower. Okay, this is a spread chart here versus silver versus gold, the top chart.
Okay.
Top chart's a spread chart. And it's week to week instead of month to month. And we go back to 2020. And back then, that's when silver and gold both surged into late 2020. And gold went up 40%, but silver doubled. Okay, so this spread went, ooh, wow, explosive move in a handful of 6, 7, 8 months, okay, in terms of percent gain in price and percent gain on the relative basis. But then in late 2020 and early 2021, the spread peaked at 1.5% thereabouts, and dropped. Now, silver also, like the miners back then, gold went into a range for a couple of years, sideways range, up and down. Silver and the miners went into a more or less staircase decline, and it particularly shows on the spread chart. So while gold was sort of going lateral, they were sort of going staircase down, so the spread deteriorated. Now, during that time, silver was going up in net price. I mean, you can go back to 2022. There was a low there at 1.05%, but the spread's above there now.
And just a quick note for the audience. Yeah. This is another ratio chart that we're looking at. So anytime the chart goes down, that's when silver's underperforming gold.
It could be going up in price at the same time,
right?
But it's still underperforming. Now, recently, you'll notice since March, April of this year, which is when gold stalled, remember, at 3,500, the spread has exploded from what are historically very low levels for that spread. Getting under 1% is like, it ain't going free, okay? Right. You're buying something that's next to free. So silver shot up, and it's now, this is last week's close, marginally above a downtrend going back to 2021. But the better line in our assessment is that green line, the horizontal. Mm-hmm. And that line gets taken out. We're dividing D silver into D gold and expressing it as a percent. That's how you come up with this number. 1.32%. You ever see a weekly close of December silver versus D gold that puts the spread at 1.32, blows out that ceiling that goes back to 2022. 3-year ceiling, perfectly horizontal, very clear. Okay, but already it's taken out a trend line. Now, if you'll scroll to the chart below, it's momentum of that spread. Okay. What we do is we take those spread readings you saw above and plot them in their relationship to a 40-week moving average of the spread. Okay, mm-hmm. 40-week average is almost like a 200-day line or a 3-quarter average. So is the spread above that average or below it? And you oscillate it accordingly. And notice that it's created the same horizontal structure. The only difference is we're at it. Momentum almost always leads price. The level that's important there is about about 0.14. You can see the scale on the left. Okay, so if silver spread it closes 0.14% above the 40-week average, which is the zero line, it will blow that ceiling. And we hit it about 3 months ago, backed off, and right now we're pressing at it again. Now, you close a week out on the spread chart at the top, about 1.26%. It's going to cause this spread momentum chart to break out.
The thing about these long-term structural rotations is that they don't announce themselves. There's no bell that rings, no headline that pops up saying, asset class shift now underway. No economist on television explaining that the quiet internal mechanics of capital flow have reversed direction. It starts subtly, like a faint tremor beneath your feet. Markets begin behaving in ways that contradict the popular narrative. Ratios start to diverge. Indicators that have been dormant for a decade suddenly wake up, and begin flashing signals that most investors aren't equipped to interpret. And before the crowd realizes what's happening, the flow of capital has already redirected itself. That is exactly where we are right now. The gold/S&P spread has been building energy for over 10 years, and now that energy is bleeding into price action. If you had a seismograph under this market, it would be vibrating. What makes this phase so interesting is that most people still believe they're living in a continuation of the post-2011 environment, where the S&P dominates and gold is an afterthought. But that era is over. It broke in 2022 when gold held firm while the stock market fell double digits. It broke again in early 2024 when gold made new highs even as tech earnings were being revised down. It broke when central banks, especially those in Asia and the Middle East, bought more gold in 2 years than they had in the previous half-century. You do not get buying of that magnitude unless global institutions believe that something foundational in the monetary structure is shifting. And the structure is shifting, the spread is showing it, momentum is showing it, price is showing it. You don't need a conspiracy theory when the charts are this blunt. To understand why this breakout is so consequential, you have to appreciate how rare these cycles are. Gold had its major breakout against the S&P in the 1970s. It had another in the early 2000s. And now in the 2000s, it's happening again. Think about that spacing, roughly every 40 to 50 years, except for the shorter 2000 cycle, which was tied to the massive over-leveraged derivatives environment that culminated in the 2008 crisis. These aren't normal cycles. These are systemic reset periods. They occur when the monetary system reaches the limits of debt expansion, when trust in fiat structures begins fracturing, and when governments resort to increasingly desperate policies to delay the inevitable. That's where we are today. The Treasury market is showing signs of stress not seen since the 1970s. The repo market is behaving like a warning siren, and the ratio charts are responding exactly the way they did in previous structural resets. It is all part of the same rhythm. The irony is that most analysts and commentators still think gold is simply reacting to rate cycles or inflation numbers. They completely miss the point. When the gold S&P spread breaks out of a 10-year base, it has nothing to do with a CPI report. This isn't about rate cuts or Fed speeches or Treasury auctions. It's about the fundamental repricing of risk. Investors are realizing that the equity market, particularly in the US, is priced for perfection at a time when the foundation beneath it is anything but perfect. There's too much debt, too much leverage, too much belief in policy tools that no longer behave the way they did a decade ago. The spread captures that shift long before the headlines catch up. That's why the breakout matters. It's not forecasting a short-term rally. It's forecasting a new era of relative performance. You can already see the consequences. Large institutions are buying physical gold in quantities they haven't touched in years. Sovereign wealth funds are quietly reallocating. Even pension funds, notoriously conservative and slow to change, are discussing gold exposure in ways they never would have considered 5 years ago. And then there's the retail side. Go online and you'll find posts like, tweet, "Every dip in gold gets bought instantly. This doesn't feel like 2011. It feels like something bigger." That sentiment is spreading because people can feel the structural turn, even if they can't articulate it. They're sensing what the momentum charts already confirm. The interesting part is how equities behave during this period. Contrary to common belief, the S&P doesn't necessarily crash immediately when gold begins outperforming. What usually happens is the stock market stalls. It begins chopping sideways. It loses internal momentum even as price may drift slightly higher. That's the deceptive part. The surface looks calm while the internal demand weakens. This is exactly what happened in the early stages of the 2000 breakout. The Nasdaq was still rising into early 2000, even as the gold/S&P spread had already turned higher nearly a year earlier. The spread was the warning, not the price level. People forget that. They always think the warning must show up as a price crash. But warnings rarely look like disasters at the beginning. They look like divergences. They look like quiet breakouts that nobody pays attention to until it's too late. The other factor that makes this breakout so powerful is the macro backdrop. When the spread broke out in 2001, The US debt to GDP ratio was around 55%. Today, it's over 120%. When the spread broke out in the 1970s, the global monetary system was trying to adjust to the end of the gold standard. Today, the system isn't adjusting. It's cracking under the weight of its own liabilities. The scale of global debt, the fragility of banking collateral, the swelling deficits, the geopolitical weaponization of payment networks, all of these forces create an environment where a gold breakout isn't just plausible, but almost inevitable. And when that breakout comes, the amplitude is bigger because the underlying tension is bigger. This is also why the eightfold pattern is so important. Gold delivered an eightfold gain in the 1970s. It delivered another eightfold gain in the 2000s. Today, from the 2015 low to the current price, we've only achieved a fourfold move. That implies we are halfway through the structural advance if history rhymes. But given the scale of the monetary distortion today, the move could very well exceed that dimension. If gold merely matches prior cycles, it goes to $8,000. If it overshoots, which is highly likely given the magnitude of global debt, it goes higher, much higher. And that's without even factoring in the implications of a breakout in the gold/S&P spread. What the spread tells us is that gold's relative performance is not just improving, it is entering a multi-year dominance cycle. This is the phase where capital begins to drain from equities and rotate into monetary assets. At first, the rotation is quiet. You don't see it on the front page, but you see it in subtle indicators. Declining breadth, falling new highs, rising volatility after rallies, and most importantly, persistent demand for physical metal even during equity surges. This kind of behavioral divergence is exactly what preceded the 1970s bull run and the 2000s bull run. And it's happening again right now.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.